Good morning. You're watching Business World Live. I'm Danie Laurel. It's 10 a.m. this Thursday morning here in Metro Manila. We are about half an hour into the trading day. Let's kick off with our top story. The government is sticking with its GDP contraction outlook for the year 2020. This is despite other risks besides the COVID-19 pandemic. NEDA acting chief Carl Kendrick Chua says economic managers see the economy shrinking by 4.5% to 6.6% this year, noting that the prolonged lockdowns would heavily weigh on performance and would dampen investor confidence. Chua also identified other risks such as weather disturbances and the possible occurrence of a La Nina in the fourth quarter and African swine fever. Disruptions in transport also pose harm to the economy. That's according to Chua. Outside the country, the trade war between the U.S. and China, as well as slumping remittances, are a bane to the domestic GDP. But Chua says that the economy could rebound to 6.5% to 7.5% come 2021. That's as economic managers agree to further reopen the economy. Chua says the IATF has accepted the economic managers' recommendation to allow more public transport as part of a shift from a policy of total aversion to risk management. He did not discuss specific plans for the resumption of more public transportation. Now, on the spending front, the government looks to shell out 1.2 trillion pesos, that is 5.4% of the GDP, for infrastructure projects next year. Let's kick off the markets with the reports on the external balance of trade. You can see on my terminal here, July exports falling 9.6%. This versus an estimate from economists surveyed by Bloomberg of 10%. So July exports were at $5.654 billion, and again, still contracting there with electronic exports down by 2.6%, but nevertheless, still better, let's say, or less worse, let's say, than what people had been expecting. Now, let's go over towards our import levels. And this also contracting, of course, as a lot of the plans of the government, particularly from infrastructure, as we had reported, are being derailed. Imports falling 24.4%. In the month of July, that stands at $7.481 billion. This vis-a-vis an estimate of a contraction of 20%. So imports falling more than expected. Now, this brings our July trade deficit to a $1.827 billion of a deficit, continuing, of course, to be a deficit here and wider than the print last month, but still wider as well than the estimate of $1.5 billion of a deficit. Now, just to highlight here, our trade deficit with China is still closing in on $973 million. We also still have a trade deficit with Indonesia, but when we talk about Japan and Germany, we are actually at a trade surplus, so still exporting more to Japan and Germany. Our exports, however, to the United States contracting by 2.7% year on year in the month of July, but we are still improving when we talk about month on month. So from July compared to June, we were actually importing more by 34.3% month on month. Our exports to China also slightly improving month on month. That's up by 1.9%. Our imports from China closing in at more than 20% of a gain month on month from July compared to the month of June. Now, let's take a quick step back and open our markets here by taking a look at how Wall Street had performed overnight. Finally seeing some green here after having seen a sea of red over the past couple of days. You can see the Dow Jones on my terminal up by 1.6%. S&P and NASDAQ as well enjoying several gains. Now, these U.S. equities were rebounding from a three-day rout. Buyers finally pushing the tech-heavy NASDAQ to its best day since the month of April. And this, of course, following an 11% drop that took down the NASDAQ to below its 50-day moving average. Now, you can see Asia Pacific here. We are enjoying the same sort of gains, let's say, at least for all of the markets that are open this morning. The Nikkei 225 up by 0.6%. Over in Shanghai and Shenzhen as well, enjoying hefty gains between 7 to 0.8%. Let's take a quick peek at our own opening and whether we are joining the rest of that regional rally. And yes, we are, albeit still not breaking above that 6,000 level. We're still at 5956.56, but that is a 0.4% gain, a little bit lower than the other Asian markets have been opening right now. Recall that this follows us having surrendered to a lot of profit taking in the middle of the week. We pulled the main index down, as I mentioned, 5,900 levels. That was the most we sank in 3 weeks. And that was after we had already broken above 6,000 levels for the first time in 11 sessions. Yesterday was really painful for our boards. We sank below our 50-day and 100-day moving averages. Now, this according to Luis Lamlinan of Regina Capital, that decline can be attributed over the growing tensions between the US and China and still the worries over the coronavirus outbreak, especially as AstraZeneca said it has suspended this late-stage trial of the vaccine after finding an illness that was unexplained in one of its participants. So, we were not alone yesterday. All Asian stocks were in the red. And also overseas investors selling again shares, extending our net foreign selling to 16 sessions. And also yesterday, it's notable that we traded at 16.2 times forward 12-month PEs. This is compared to what we normally trade at a 10-year average already at 16.4 times. So we are well below the 10-year average. Now, just quick check on our sectors this morning, whether everyone is enjoying this broad-based rally. Not necessarily the case. You can see properties holding the fort there, up by 0.8%, together with services and holding firms. But if you take a look at financials and industrials, they're still very iffy here, still in the red. Now, let's take a quick peek at the biggest movers and laggards here this Thursday morning. Alliance Global is up by 2.3%. So a lot of our conglos here, AGI, JG Summit, Metro Pack seem to be bringing the bourse up. Whereas when you take a look at First Gen, that's down by 2.1%. A lot are watching that after they had announced that there's some announcements or reports going around about some power plants being shut down, but we're going to wait for more information on that. LTG Group as well, losing 0.8%. Let's take a quick peek at our telco players this morning. This is Globe Telecom says they are expecting 900 more cell sites to be built. That's as soon as its partnerships with the tower builders are now in advanced stages. So some of their partners would be Aboitiz Infra, iSoc, E.co, Transcend, and CREI Philippines. So several with that, they said that they have advanced to active acquisition and build phases. So where will they be building these towers? About 200 more tower sites in Cebu, Davao, and Subic, plus the completion of 300 sites in Luzon and 400 more sites in the Visayas and Mindanao region. I recall that the government is hoping 50,000 shareable towers will actually be built in the next 7 to 10 years. And you can see here on my screens here, Globe opening in the red, actually flattish, down by 0.09%. Meanwhile, Smart 4G LTE is now on Pag-asa Island in West Philippine Sea. This is actually a controversial island because it is the most remote cell site in the Philippines. It's, of course, in Palawan, in the West Philippine Sea. There were reports in June saying that when visitors visited the island, including government officials, they received welcome messages from foreign telco providers like China and Vietnam, and nothing from the Philippines. So finally, Smart Engineer had said that now there is a welcome to the Philippines message when you open up the LTE over in Pag-asa Island. Now, still on utilities, take a quick peek at Meralco. Meralco rates are falling for the 5th straight months. This as, of course, power rates are going down. And good news for households, you're likely to see 12 peso cut in your bills. This is according to their statement. So what they mentioned is that the generation charge is remaining rather low. Supply contracts are still relaxed due to the impact of the pandemic on power consumption. So overall, they've actually saved Meralco from a more relaxed supply contract. So their savings reached 2.4 billion pesos, basically because they can invoke a force majeure on their supply contracts. Power charges also from WESM are actually lower. So buying electricity at the spot market was also lower, even as, of course, Meralco was ordered by the government to provide some subsidies to more than 2 million poor customers. So that was around 275 million pesos that they gave in subsidies. That's around 22% of the total bills of these households. And this after, of course, Meralco was fined by 90 million pesos over alleged violations. This was from the Energy Regulatory Commission. So take a look at Meralco opening now by 1.6% up at 269.20 pesos. Now, moving on to fixed income, I just want to open up our yield curve here over in the Philippines because we have some exciting news, and this, of course, from the Bangko Sentral. They will be issuing their own securities starting next week. So that's going to be September 18. The BSP will say that this will become an additional tool in managing liquidity in the financial system. So initially, these BSP securities will be around 20 billion pesos worth of 28-day bills. And they will be auctioned, and hopefully will be auctioned every week. So why is the BSP doing this? Well, one of the functions of BSP securities is to help guide the market interest rates, especially when you're talking about the short-term end of the yield curve. This provides a bridge between the key policy rate, which is, of course, their target, and which is right now at a historic low, and the rest of a yield curve, which, of course, can help guide banks in pricing their loans. Now, whether or not this will be crowding out the rest of the TDFs or term deposit facilities, which the BSP has, which are being offered by the Treasury, there will be no crowding out effect. This, according to National Treasurer Rosalia De Leon. She says that there's a lot of oversubscription when it comes to the TDF, so there's still a lot of excess liquidity, and this can be mopped up by these new securities. So this from SEB's Eugenia Victorino, because of this own bond of the BSP, they can now better anchor the market interest rates to the policy rates if there are significant misalignments in the liquidity. Now, very quick peek on the local currency, our peso set to stumble with a drop in foreign bond sales. This, according to some strategists like Jonathan Ravelas from BDO. He's saying that because of the strength of the peso now, corporates are going to start borrowing domestically instead of tapping the offshore markets. For instance, San Miguel Corporation is now prioritizing the local markets from fundraising. We also had, from the Bureau of Treasury saying they will be looking more at domestic sources and increasing the borrowing needs using peso instead of going overseas. The peso strengthening, however, this morning at 48.59 to the greenback. Okay, guys, let me scroll down and check in on the biggest headlines we are watching. Today is Thursday morning. Senators question the economic team's priorities as seen in the proposed 4.5 trillion peso national budget for 2021. Now, this as allocations for health and social safety nets were cut, while funds for infrastructure projects increased despite the ongoing pandemic. Now, for starters, Senator Franklin Drilon asked why the health department's budget was slashed by 14%. Lawmakers are skeptical whether the department's budget allocation will be enough to cover contact tracing, treatment, and vaccination efforts. Drilon reminded economic managers that protection of public health is the key to economic recovery. He also lamented the glaring absence of funds for a social amelioration program, or SAP, for next year. To top it all off, Senator Ping Lacson asked the economic team to explain why the DPWH and the DOTR still received higher allocations, that's despite their history of underspending. But Budget Secretary Wendell Avisado defended the 1.1 trillion peso proposed budget for infrastructure projects, saying the two agencies have committed to ramp up implementation of the Build program. Now, more than anything, the government is pinning its hopes for an economic recovery to robust infrastructure activity. Now, this from the Philippine Star, the World Bank said transforming the country's agriculture industry into a dynamic sector is essential to boost economic recovery. But during the virtual launch of their latest report, the World Bank said the agriculture sector must shift away from heavily focusing on specific crops towards improving its overall competitiveness, resilience, and sustainability. The report adds that it's even more important to transform the country's farming and food systems to ensure strong food value chains and affordable and nutritious food for Filipinos. The World Bank stresses that no country has successfully transitioned from middle to high income status without effectively transforming their agri-food systems, with the exception of a few but natural resource-rich countries. For his part, Agriculture Secretary William Dar believes that although the sector has been in a critical stage, they must adopt a more comprehensive science-based and inclusive food production and distribution system to ensure resiliency. The World Bank is currently supporting the Philippines through programs aiming to raise agriculture productivity and reduce poverty in rural communities. The Philippine Star also reports that firms in Metro Manila as well as nearby provinces lost up to 1.5 trillion pesos in sales in every month that these areas were in a lockdown. Citing data from NEDA, Finance Secretary Sonny Dominguez noted that imposing new quarantine measures would inflict more pain to the economy as only 32% of it was effectively open under lockdown. Dominguez says that those strict quarantine measures were necessary to save lives and ensure public health. The government is preventing another lockdown from happening by keeping the virus at bay. The finance chief said, though, that there are also signs that the economy is starting to recover with its gradual reopening, particularly in terms of employment, manufacturing, and revenue collection. He also said there has been a continued slowdown in the contraction of manufacturing production, which signals rising economic activities. Both the Bureau of Customs and the Bureau of Internal Revenue also managed to exceed the revised targets for August by 33% and 46% respectively. In a year of difficulty, one stock has outperformed the rest, and many are putting their eggs in the technology basket. Here to share with us their big plans in the new normal, we have PLDT's Chief Revenue Officer, Panlilio. Good morning, sir, and welcome to Business World Live.
Hi, good morning, Danie, and I hope you're keeping safe. Good morning.
Sir, just a general sentiment on the pandemic and, of course, how it relates to the plans of PLDT. On the one hand, a lot of your plans got derailed, just like everyone else. This was unprecedented. You already announced the CapEx cuts and your projects put on hold. On the other hand, lots of sudden opportunities have come up. Has the net effect so far been generally positive?
Yes, it has been actually we are surprised and very lucky actually that we are in an industry where it's become really an essential to our countrymen, no? And I think very important service that we provide. The demand has actually increased during the lockdown. Our data traffic spiked by 30%. We're just very lucky that it is a service that's been essential today. You know, Danie, sometimes they say connectivity is the new oxygen and data is oil. And we have seen that spike in demand and requirements for our service. And we have been hit by the lockdown for sure. In April, there was some softness in our business, but at the end of the day, sometime after Holy Week, our volumes have gone back. In fact, our volumes in our top-ups have been even much higher than pre-lockdown periods. Our first half, we're able to actually, in terms of net income, slightly higher than last year, same period. I mean, despite the fact that there was some softness, as I said, in August, in April. And I think initially also our installation capability and our network, crewmen ability to expand the network was impacted because of the lockdown. Again, they could not really move around, couldn't do their work that they needed to do because of the strict movement restrictions in the country. But again, after the lockdown and the GCQ now that we've been able to ramp up our installation. In fact, our installation volume today is even higher than pre-lockdown. So we're able to be more efficient, be more productive. Our outputs are better. So we're hopefully seeing even a much better second half compared to first half. So, but again, we are here to really support our countrymen, a lot of the businesses that have been impacted, all our segments in the business in terms of individual consumer wireless is up double digit compared to last year. Our home business is also up, strong demand in home broadband for sure. Our softest segment, but still growing, is our enterprise business. As you know, a lot of our customers are affected by this lockdown, by this pandemic, and but we're trying to help them get back on their feet. And the only way we would continue to grow our business if we are able to help them rebuild their businesses also. So very strong performance for us, surprisingly, in the first half. Now that we're almost at the tail end of the third quarter, we're still seeing growth during the third quarter. So I think, again, very lucky that it is an essential service today, Danie.
Sir, thank you for that update. We'll go through those earnings a little bit more in detail later on. Just to be a bit more anecdotal here, the more that it becomes an essential service, the more people start becoming critical also about the service, diba? And especially now, nobody expected to be working from home, nobody expected to be studying from home. A lot of complaints for sure. Are these complaints justified? Was the traffic of data right now, or at least during the pandemic, too much to be handled by the current infrastructure? And what is the immediate solution here to provide, as you mentioned, an affordable service without compromising the quality?
Well, actually, in terms of our ability to manage the increase in data, we were able to do that. We didn't have problems in terms of managing the capacity requirements. Initially, the first few days when the spike happened, we had to increase our international capacity for sure. Because as you know, Filipinos, in terms of internet access, would normally, it's not local content. Most of it will be US content. So we had to expand our international capacity, and we were able to do that quickly. The other thing was a lot of the traffic that we normally see in the CBDs went towards the urban or the terms of residential, because everybody stayed home. As you said, working from home, studying from home. So we had to do some refarming of frequencies, which was done remotely and very quickly, to be able to make sure that we're able to handle those capacities. But we were able to manage it. I think that the network held off. It just shows you that the investment that we've done and the strategic the decision to invest on improving the network for the past 5 years, we've spent, Danie, about 260 billion already in network. That has been significant for us in managing and trying, being able to serve our customers. I mean, there will be complaints. We acknowledge that. We had issues with installation, as I said. Physically, we couldn't really attend to those because we were not allowed to. But today, again, we've recovered. But demand also is higher. So we do need to improve our installation capacity even more because demand is there. And of course, obviously, when customers need the service and we're not able to install, obviously they will complain, and we want to make sure that we're able to handle that. So that is a ongoing process now. We are in fact trying to double the capacity of installation that we have today, but it takes time for us to develop that. But we are making sure that we're in touch with our customers. We're making sure that we're able to, if ever, serve them temporarily with other services for the meantime, like pocket Wi-Fi's or fixed wireless, until we're able to give them fiber. So we're trying to manage the demand. We understand. We're trying to increase our capacity, but yeah, it's really we know we need to address those issues as we move forward.
Sir, what solutions are you urgently focusing on? What's the target here? Is it to provide more coverage, even if those speeds are lower, to a bigger part of the country, for example? You also have this Fiber for All program. Do you want to replace the current structures and make them faster. You're still focusing on 5G, which 5G as a technology is concentrated in central business districts, so it's still in very focused areas rather than a
Correct.
bigger population. What's the new strategy now going forward?
Well, our North Star is our customer. We would have to really make sure the customer experience is excellent for our customers. No, so in terms of this fiber for all, these are really your ADSL customers. So as you know, ADSL is a legacy technology. So the experience there is not good. So we embarked on a project starting last August on an 18-month project to really migrate all our ADSL customers to fiber. And by the end of the year, we have about say 650,000 customers on ADSL. So a third of that will be migrated by the end of this year, and most, if not all, will be migrated by the end of next year. So that's our thrust in terms of improving customer experience. At the same time, existing DSL packages, for example, if they pay 1699 for 15 Mbps, once we shift them over, for free, of course, going to fiber, we will be giving them 25 Mbps instead. So we're improving the packages that they have. We want to improve the experience. And for sure, in terms of network, it will be a continuous effort to expand coverage, expand capacity as we see demand growing, as you said earlier. No? So we will continue to spend capex. I think this year we initially said 83 billion. We brought it down to 63, not because of by choice, but again, the ability for us to go out there and do the work was just not possible. But since then, since our first half report, and we've now ramped up our work in terms of network, we are bringing that up to about 70, if not 72 billion, which is the same amount that we spent last year. So we continue to spend on the network. We continue to as we said during the first half, and the commitment of our chairman MVP to the president, that we will continue to improve our service. That will still happen, and that will continue to happen.
Sir, how do all these plans relate to, let's say, our rankings when it comes to fastest, internet speed, even mobile data? We're still definitely not within the best ranked, even in the region. You are, of course, the best in the country, but still, in the region, when we compare to other countries, what are your targets? And what really does, from a very basic perspective, what does a customer need to be able to work properly, to be able to study properly, and how does this relate to your rollouts?
Well, I think you're also referring, Danie, to the Ookla report.
Correct.
No?
Yes.
Of course, there are two segments there: fixed and mobile. On the fixed line, we are 22 out of 33 as a country. But if you separate PLDT, we go up by 5 slots to 17 out of 33. For mobile, we are 25 out of 30. But again, if you separate smart, we are 8 spots better than that. So we're 17 out of 30. But having said that, of course, we are not happy with that. No? And what we have said to ourselves is we will benchmark ourselves not with competition here, because as you pointed out, Danie, we're already better than competition. We want to compare ourselves with countries like Thailand or Vietnam, where maybe the average speeds will be between 25 to 30 Mbps. At those speeds, I think working from home, studying from home, you will have a good experience already in terms of connectivity. No, of course, if you can have higher, of course, you want that. But at 25 to 30 Mbps, you will already have a good experience.
Okay. And sir, finally, before we let you go, since you already mentioned about competition, how are you positioning yourselves? Now there's going to be a third telco player coming on board here. And also, there were recent remarks by President Duterte and his SONA for the need to generally improve the services for all telco players, sir. Has it gotten easier in terms of getting tower permits? Has there been an important change in terms of your priorities right now because of all of these moving parts compared to your previous plans before?
Well, We have not really changed our plans. I mean, we continue to, as I said earlier, we will continue to improve our service, our network. That's why we are aligned with the president in terms of his statement that we can improve our service. We acknowledge that. And as I said, we will benchmark ourselves against countries like Thailand and Vietnam to be better. That will be our benchmark. And I think every Filipino deserves that kind of service. In terms of having the and again, based on that, is we need to improve coverage. And one of the key elements in network is towers, no? And I think the initiative of government to make it easier for us to be able to build out towers would be, would hello?
Yes, sir.
Did I
Right.
lose you, Danny? Sorry.
No, we're here, sir.
Yeah, so the ability for us to build towers, more towers quicker, will be a big help in terms of improving coverage. We typically build 1,000 to 1,500 towers every year anyway, and I think as we get into 5G, there will be the technology of 5G needs more dense towers at the same time, no? But I'd like to say, Danny, that towers is just one element of the entire network infrastructure of PLDT, and we do have a very complicated infrastructure because we have both fixed and mobile. Aside from towers, you need an extensive fiber optic network, which we have. We have about 360,000 kilometers of fiber optic network. We have about 10,000 towers, about 90,000 what do you call this, base stations. I mean, because in one tower you can have a lot of base stations. We have a lot of data centers. So, and then we also have a lot of partners in international capacity. So that's the entire network that you need to build to be able to offer a service. So about competition, I think what we can only do is become better. Now, competition has to step up also to compete with us to do better. So in terms of dito, they still need to build their network. Until they're not able to build a network, then it will be difficult for them to compete with us and also with Globe. Globe is also not relaxing. I think I saw your earlier portion that they were committed to also to add 900 more towers, right? So both Globe and Smart and PLDT will continue to build our network, and that will be a challenge to Dito. How fast can they ramp up in terms of building their network and the ability for them to compete.
Okay, thank you, sir, for those insights. And we are, of course, looking forward to all of these plans coming into fruition. Good luck with that. We all, of course, are rooting for these things to happen and for everyone to have better internet access. That was, of course, Panlilio, Chief Revenue Officer of PLDT.
Thank you, Danie. Have a good day.
Yes, sir. And that's a first look into the business day. Today is September 10, 2020. Catch us again tomorrow morning. I'm Danie Laurel, and we are What News.